Hey YouTube, I'm Jimmy. In this video, I'm going to go through my top 3 defensive stocks that could have a good 2019, especially if the market keeps going down. So to make this list, I looked for companies that had a decent dividend yield. They had defensive characteristics in that investors seem to like investing in them when the market goes down, and they appear to be financially stable. So our first company is the American Waterworks Company, ticker symbol AWK. AWK has a dividend yield of right around 2%. Here's what their chart looks like. And as you can see, AWK fell last week right along with the rest of the market. Now on Friday, AWK announced the acquisition of Sheridan Water. They're a water company located in central Indiana. This acquisition, like the others that AWK has made, should prove useful for earnings per share, as management has stated their goal to grow earnings per share between 7 and 10% each year through 2023. Now this is a chart of AWK's earnings per share going back to 2011, and as we can see, it's done quite well. AWK currently has a forward PE of about 26x, which is certainly on the high end, but I believe it's trading there mostly because the second half of 2018 was very good, not just for AWK, but it was good for the entire water utility industry, as it's been very defensive and the market's been in quite a free fall. And in case you haven't seen it, here's what the S&P 500 has done for 2018. And right around the end here, you can see it looks like the market jumped off a cliff. Okay, moving on to our next company. Next up, we have a healthcare real estate investment trust called Community Healthcare Trust, ticker symbol CHCT. CHCT has a current dividend yield of about 5.5%. Here's what the price chart looks like. Now, what makes this company interesting is that obviously it's in healthcare, so that's defensive, but it's also in real estate. And you may have heard the news recently that people are talking about the flattening of the yield curve, which generally means that long-term rates are coming down. If long-term rates come down, that should help the mortgage rates. So I figure if we combine the mortgage rates, that should help real estate. You take the healthcare, which is defensive, you end up with a pretty good combo when you put those together and come up with a real estate healthcare company. Now, when I say CHCT's in healthcare, what I mean is that they own the properties that are leased to hospitals, doctors, and healthcare systems. So it's likely that the revenue generated from those properties is going to be sticky revenue. Now, CHCT's management has stated their desire to continue to acquire small properties each year to help grow revenue and help grow their dividend, which they've tried to increase a little bit each quarter. Now, typically with REITs, we don't use PE to measure their, to try to come up with valuation. Instead, we use something called funds from operations. So if there, we'd want to look at price to FFO. And currently their price to FFO is about 18x. Now, most analysts that I've seen covering this stock has their price target somewhere between $30 and $32 per share. Right now, they're trading at about $28 a share. So if the markets keep going lower, I expect CHCT could reach analyst price targets and possibly move a bit higher because of its defensive nature. Now for our next company, we have a more popular company, and that is Pepsi, ticker symbol PEP. Pepsi has a dividend yield of almost 3.5%. Here's what their price chart looks like. And I think it's important to realize that Pepsi's business is by its nature very defensive. They own Mountain Dew, Gatorade. They recently bought SodaStream. They own Aquafina Water. They own potato chip maker, Frito-Lay. And generally, this type of business does very well when the economy heads into a recession because it's unlikely you're going to stop making those purchases. Here's a chart of Pepsi's earnings per share. And as you can see, it's been doing pretty good over the past few years, especially like the past 3 years. Right now, Pepsi's trading at a forward PE of about 19x, which is below Coke's 22x. So I expect PEP to have a solid 2019, especially if the economy slips at all. Coke will probably do pretty good itself, but I like the dividend yield that Pepsi's paying, so that's why I went with Pepsi over Coke. Historically speaking, dividend stocks do very well coming out of a market downturn. So it's key for us to hold on to our high dividend positions all the way through the market's eventual recovery. Now, as I shoot this video, the market's down again today, and I noticed that oil was down as well to about the mid-40s. So if you hold any energy companies and they pay good dividends, you may be seeing those stocks dip lower now, but once again, it's my opinion that we should all sit tight and wait for the market to sort itself out. And the high dividend stocks, like I said, historically come out of it stronger than most companies. So the real question is, with what's been going on in the market lately, is this a prolonged downturn? It could be. I'm not sure if it is, since the economy is still moving along. But if the economy tips over at all and starts heading lower, then it's possible that 2019 ends up being worse than what 2018 was. But it's also possible, if the economy stays in there, that 2019 shakes out to be a pretty good year. So I think what's important for us to do here is to take a good look at our portfolios and try to determine which companies we like the best, which companies are fundamentally still doing well. Then our dividend stocks, like I said, I think if we hang on to those, they should do pretty good. And I think if we have any speculative plays, they're likely to get hit more than everything else. I think that it's important that what we do usually is to sit tight during these downturns. Often, back in the Great Recession, I saw many people that I knew that had their money in the portfolio and eventually were afraid of the losses, so they pulled it out and waited. And with that waiting, they ended up missing a very good 2009, 2010, giving back where they could have gotten back most of their losses, but instead they jumped out. So I think it's important not to jump out too early here. That's just my opinion. Do you agree? Let me know if you're waiting it out on the sidelines, or you're adding new positions, or you're just holding on tight and waiting to see what happens with the markets. Let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button. And thanks for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.